Hello, everyone, and welcome back to another episode of the Market Outlook series with me, Kavita Agrawal, the founder of EXP Invest. We are here to talk about what has happened in this week, and this week has been a lot of correction, a lot of volatility in the market. So it's very important to take an objective look at the market activity at Nifty, at the sectoral indices, and plan the next move ahead. Now, at this point of time, I understand that a lot of you might be stuck in positions and might be really getting worked up looking at all the reds in your portfolio. And I just want to remind you that risk management actually needs to be done when you are not faced with the risk. If you are worrying about the risk, about the losses that you're facing now, it's a little bit too late. Risk management is something that needs to be done on an ongoing basis. It's very important to have your stop losses set. So after this discussion of Nifty, I am going to be assessing some stock analysis requests. And in that discussion itself, I will also tell you about how my own trading has been and how my own experience this week has been. So stay tuned for that. For now, let's get started with the 3-minute time frame of Nifty. So 3-minute time frame of Nifty right here for us. Last week, we assessed this part and we noticed that Nifty was clearly giving us very mixed signals and we were expecting volatility. We were expecting volatility for the next 2 to 3 days, not the entire week. But this entire week has been extremely volatile. So all the way from Monday's high opening to Friday's low opening, we can see the Nifty has lost between 3.5%. And if you look at it on a close to close basis, that's around 2.6% loss this week. What does the latest analysis suggest? The latest analysis, what I am seeing is that this very last leg of decline that we've seen, now there is a characteristic that is jumping out at me, and that is for most of the time, except for Friday, most of the time, Nifty 3-minute time frame RSI was able to sustain above the level of 60, which to me was seeming very promising. Unlike the previous week, in which we saw the level of 30 get violated multiple times. However, this story of strength did not sustain for a long time because the sharp nosedive that we experienced in the first half of Friday, in that Nifty did breach the level of 30, which basically is repeating the past here in the sense that the index went oversold and overbought very quickly, which just indicates that there is strong underlying volatility and also is a sign of further weakness. Moving forward to the 15-minute time frame, 15-minute time frame is looking very weak. We are seeing a clear negative range shift here, which means that the RSI is resisting the level of 60 and breaking the level of 30 upon every new leg of correction, which is very poor signals. So here my support on Nifty right now is 23,900, as my previous support was 24,500, which got breached pretty brutally, I would say. So 54,500 was this. So we saw slight support there. Nifty spent a little bit of time. It also coincided with the 100-day EMA of the daily time frame, but it did not sustain. Once, in fact, that support was breached, sharp decline has been noted, and 23,900 is where I expect support to come back in. Why 23,900? Because of this low. So this low, as you can see, was forged on the 5th of August 2024. And right now, I believe that the market can stay volatile until Diwali. After Diwali, maybe stability or even bullish momentum might return to the market, right? Which basically means next week. 75-minute time frame, there was a positive divergence, which we noted last week or even the week before that. But looks like this was just a negative divergence in a bear trend, and it did not really give us any positive movement. So when we see a positive divergence, there are one of the three things that can happen. And this is something that I've always taught in my advanced swing trade training program, but I'm going to share it with you here also. So never take a positive divergence for granted, just like anything else in the stock market. So when a positive divergence occurs, be prepared that there are one of the three possible outcomes. The first possible outcome is the most favorable one, that the price is going to rally, the price is going to reverse, and a new leg of rally is going to begin. That's the most favorable outcome. That is what we all desire, but not always. What happens? The second outcome is that the positive divergence has occurred in a strong bear trend. As a result of that, it can give a small recovery and then the bear trend will continue. And the third and the least favorable outcome is that the positive divergence is a fake divergence, or the positive divergence just it's by the book, everything matches, but it doesn't give you any upside whatsoever. So this is the worst scenario of the positive divergence. There was a proper lower low on the price, there was a proper higher high on the RSI. So this is a legitimate RSI positive divergence, but there was no upside activity seen whatsoever. In fact, the price continued to decline and it broke below the low of the positive divergences right hand side low, invalidating it basically. So this positive divergence on the 75-minute time frame fizzled out without any activity, the worst case outcome typically, right? So that is a little bit of a side note on RSI positive divergence and possible outcomes. Now, what the 75-minute time frame is telling us. This is telling us that the RSI has again breached below the level of 30 while forging this low below the level of around 24,210, is it, or 24,088, roughly close to 24,100. Like I said on the 15-minute time frame analysis also, that more volatility can be expected, more downside can be expected, and for now 23,900 is where my support lies. What about the daily time frame? Now, one very important daily time frame development that has taken place is that the support range of the bull range support zone has been breached. So Nifty after a long time has come below the level of 40. When was the last time below this level? It was here in October 23, which, if you remember, was again the Diwali time. So I feel like last year's story is repeating again, where the market had gone into correction in the mid of September back then, or actually the market had topped out around July, given like a last leg of rally up to the mid of September, and then gone into correction, correcting about 6.5% roughly from the peak. This time around, what are we seeing? That Nifty has continued to rally a little bit beyond the mid of September, but then the correction has been a lot steeper. We are already down 8.5% from the market peak. So 23,900, and I'm expecting next week weakness to continue. If 23,900 is also breached, then further assessment will be required with respect to what to expect in the market. So what should be the strategy considering that there is so much correction happening in the market? I believe your strategy, if you are a short-term swing trader like me, you should focus not on the profit and loss, the consequence of trading, but rather your planning. See, at the end of the day, it is impossible for anybody to predict the market. What can you do? You can stay prepared. You can be prepared. At any point of time, there is no certainty of guarantee. There is only a certain probability. So if you have a certain approach to taking positions in the market, sure, do that. If you are seeing something that appeals to you, go ahead, put your money in. Have a checklist. If your checklist is getting fulfilled, then go for it, invest. But again, manage the risk. Don't leave your capital exposed to market forces. What does that mean? That if your thesis was wrong, or if everything you did was by the checklist, but still the market is going against you, this is just what the market does. It's market risk unfolding on you. What is the worst that will happen? Your stop losses will get triggered. You will incur a small loss, but you will be able to protect your capital from drawdown. Now, that is something that a lot of people fail in doing. If you're not going to protect your capital from major drawdowns during the bear market, your capital is going to continue to stay stuck in poor quality stocks, as a result of which, when the bull market finally comes, you will have no liquidity whatsoever. And there is no saying whether the stocks that you held on to because of your loss aversion bias are going to start rallying when the market actually begins to rally. And you will often see that after the bear market, when the market starts to rally again, very rapid recovery comes in. Stocks which catch on to the momentum, not necessarily the stocks that you have in your portfolio. If you are holding on to winners of yesterday because in the previous bull cycle they gave very good rally, they may not participate in the next leg of bull run whatsoever. And one thing that I have noted in my experience in the market is that when a major correction ends and a new bull run starts, typically it is fueled by new sectors coming into rally. So I think chemicals, agricultural chemicals, these sectors are going to be in major focus. PSE sectors, financial sectors, banking sectors, not so much. So that is something that you should pay attention to. Even pharma, healthcare, I think these sectors have already rallied a lot. So you need to be careful. Now let's move on with Bank Nifty analysis. So in Bank Nifty, I am seeing that the correction is not as terrible as it is in Nifty, to be honest. Here, Bank Nifty has fallen around 7.5%, but it is also sustaining the support around 50,500, which is very good. However, we will still keep an eye out on 49,700 in the event that this support does break. I am seeing a positive divergence on the 75-minute time frame, which is quite refreshing, not something that we saw on the Nifty's chart. However, if you look at the volume here, the volume on the last leg of decline has been pretty high. It does look like this is the beginning of a ABC correction, where leg A of the correction has taken place. This was leg B. This is leg C, and it does look like we might go for the retest of this support level right here, which is exactly where Nifty support also lies. So for Nifty also, we are expecting support to come in from the mid of August low. And on the Bank Nifty also, 49,700 seems like a pretty good support zone. So now let's take a look at the intersector index chart. A lot of you have been asking me how to make these charts for yourself. So I'm going to show it to you really quickly. And I will just adjust this chart so that even the Instagram followers can see how to make this. So it's very simple to make this. All you need to do is, first of all, open the CNX 500 chart. Second, change it to line setting, and then click on this compare or add symbol. And here, one by one, add all of these index sectoral indices. You can see it on my screen. You can take a screenshot by pausing the video. So these are all the sectors that are there. You can share that. Or what I will also do to make your life easier is I have a watch list of all indices. So I am going to go and copy the link of this watch list, and I'm sharing this in my Telegram channel. So this is my Trade with Kavita Telegram channel. So if you want to connect with me, if you want to know about services I give, or if you just want to be a part of my community, then join this. So I'm going to paste this link here, and this is called the Trading View All Indices list. Now, the link to this message, I'm going to put it in the comments so that you can find it on my Telegram channel. The reason why I'm putting the link to the Telegram channel is because in this Telegram channel, if you go into media, you will also be able to find some files, some books. For example, this is one book that I always recommend to people who want to learn technical analysis. This is the Kirkpatrick and Dahlquist's book, which I have studied more than 7-8 times till date. This was part of my CMT curriculum, and I still find myself going back to this book. This is amazing. That is something that you should definitely consider. There are a lot more other resources that are in my Telegram channel. So if you have some time, I would suggest just go into the media section, the file section, video section, and just browse it a little bit and stay in the channel to stay connected with me. So coming back to this analysis, now want to look at the stocks, the sectors from the Friday closing and see who's won, who's not. So I don't care about the line, I care about this order, because when I set the zero date of Friday here, so this is saying 10:30 a.m. This is 11. Yeah, there you go. So Monday morning. Let's consider from there you go. Monday morning. So now what I'm seeing that from Monday morning onwards, what has been the ranking of the sectors in terms of performance? So since Monday, I can see the metal sector has fallen the most. It has fallen 7%, followed by the PSE sector, the realty sector. So all these three sectors were the winners of yesterday, and in this correction, they've received the maximum beating. Consumer durable, PSU banks, again, two more sectors which have been giving fantastic rallies. So if this is exactly what I'm saying, that if you indulge in FOMO trading repeatedly, right, if you're buying stocks after the rally, this is what happens. The stocks which have rallied the most, which have exceeded their valuation significantly, are the ones that are going to get beaten. So you want to be very mindful of getting into stocks after they rally. Buying on dips, as long as a higher time frame is suggesting a strong underlying bull trend, is one thing. But buying a stock just because you think it has rallied so much and you can't be so unlucky it's going to top out exactly when you enter the stock, trust me, that is exactly what is going to happen. Have a strategy, stick to it, do things in a rational manner, not an emotional manner. So, what are the other sectors? So, anything below CNX 500 basically has underperformed. So, infra, energy, auto, these also were like winning stocks and they clearly have underperformed. And outperformers, if you see, these are the what we call the defensive stocks: FMCG, consumption, pharma, healthcare. These are defensive sectors. So these have outperformed, but even they are ultimately negative. So the correction in the market has been pretty real. And I personally think there are two factors behind this major correction in the market. The first factor is that the Chinese government has given stimulus, which is attracting foreign investors, due to which we are seeing outflows. And the second one is that sometime back there was a news that the Japanese bank is increasing rates. So for a long time they have had negative rates, because of which a lot of investors were getting funds from Japan and investing it worldwide. Now with their increase in interest rates, cost of capital for those people has increased significantly. A lot of dynamics basically has been disturbed right now. So there is, on one hand, a very attractive investment opportunity for foreign investors. On the other hand, the cost of capital also has increased for a section of foreign investors. So what does this mean for the Indian market? Does it mean that there is some problem in the Indian market? The answer is no. I think that the Indian growth story remains intact. The Indian market continues to remain a very attractive destination for investments. And the retail traders itself in India, if they start believing in the Indian retail story and start investing strongly the way they should be investing, right, the Indian market is going to sustain. So, what about this correction? Should we be worried? The answer is no. Once these changing macroeconomic and global economic dynamics settle down, rally will return to the market. I strongly believe that the underlying trend in the Indian market is still very strong. The macro story is very good. Growth trajectory for stocks is very good. In fact, right now is a very good time for making long-term investments in the market. And I'm going to be showing one new stock in my long-term plan. There are already lots of stocks. In one stock, we've booked profits this week. And for the other stocks, I am recommending to the members where they can add more, because the risk reward ratio is more than 3 and there's ample headspace left, growth space left in those long-term stocks. So if that is something that you're interested in, then just hop over to my Telegram channel. And somewhere here, if you go to links, there you go. See, on 25th October itself, I had shared it. I'll just share it again. So you can just check out my long-term plan and explore if that is something for you or not. But anyways, coming back to this, market is very risky for short-term swing trading. However, I don't recommend you to sit on cash, of course. If you see a setup that suits you, that's what I am personally doing, right? I'm not sitting on cash. If I am seeing a setup which appeals to me, which meets my checklist, which fulfills the criteria that it needs to fulfill, then I'm looking at the allocation amount and I'm going ahead and putting the money in, but not without a stop loss. If you don't have enough time to set up stop losses on your active trades, then just don't trade. You have to set your stop losses at the time of making your positions. A lot of people have this complaint that stop loss gets triggered and the stock goes up. If there is sustenance, if there is strength in the stock, it is totally fine to re-enter the stock later if you have solid reason to believe that it is going to, again, objective reason to believe that it is going to sustain the rally, and set your stop loss again so that your capital doesn't get stuck in drawdown unnecessarily. So you have to stay objective, and remember, it's all about the odds. It's a game. You just need to show up every single time, and you need to make sure that you survive in the game. If you keep getting wiped out, if you keep losing all your capital because you use leverage and you're careless about it, there's just no point of playing. So with that, let's now move towards our stock analysis requests. I have received some requests. from the members who are part of my Telegram channel and also members who watch us online. Now, if you also want your stock analysis request to get assessed in the future videos, just go on the link at the top of my head, expinvest.in/stock request or /stock analysis, whatever you can remember. Both of them will lead you to the same page and submit your request. So the first stock we will begin with is PC Jewelers. So Vivek has submitted the request for PC Jewelers and his average cost is 185. Let's get this favorite tools bar out of the way. And this is the daily time frame of the stock. Let's draw a horizontal line and 185. So you're holding this stock. Oh, right at the top. This seems like a rookie mistake and looks like the strategy you probably went with is all-time high breakout. Very poor strategy, honestly. Because see, all-time high breakout can work beautifully sometimes when you're entering at the right time, but it requires analysis. An all-time high breakout after a major correction might work, but an all-time high breakout after a massive rally is usually a bull trap. And you seem to have gotten caught in the bull trap. There was very clear negative divergence here, and the absence, I wouldn't say, yeah, clear absence of volume. So see, this is the point up to where the price rallied, and look at the volumes. So this histogram is showing you the comparison of volume between 20 versus 100 days. So 100-day average volume is a zero line, and then over last 20 days how the volume has fluctuated, it is showing you. So in the last leg of rally, you can see the volume has been pretty dry, which was a giveaway sign that the rally is not going to sustain for a very long time. And then if you also look at the rally, this next leg of rally, here though the volume has absolutely declined. Volume high kab tha when the price declined, that is when the volume went up, which was a clear cut signal that boss, heavy selling is coming. Sellers now suddenly have the power, which means supply has increased. So this was an opportunity to get out of the stock. Now what should you do? If I look at the 75-minute time frame, 75-minute time frame is also suggesting that correction can continue. But again, when I look at the past trends in the stock, I can see the stock has a tendency to give small bounce ups. So I think I will set an alert at the level of 51 on my RSI of 25 period on the 75-minute time frame. Right. So basically, I think the stock can retest the 20 EMA, which would be like a 12-13% upside for you around the level of 157, 158. And any bounce back that you see in the stock should be used by you as an opportunity to exit your holdings in PC Jewelers. I think the rally in jewelry stocks has come and gone, and it's no longer attractive for you to hold on to. So Rohit requested for Valor Estate and he's entered the spelling also wrong. So I really request that if you want to submit a stock request, please quickly do a Google search and enter the correct ticker name. Otherwise, it's just very inefficient and wastes my time. So we are going to correct this. This is DB Reality, basically. The ticker name is DB Reality. So we will take a look at that. Now, Rohit says that I am having a long-term horizon another 6 months, and you have around 20,000 shares at 193 cost. So let's identify your cost level. There you go. So that yellow line is the cost. But the stock, in spite of having positive news, joint project with IT and projects awarded by the Mumbai Municipal Corporation recently, clearly is in correction. See, trading on the basis of news is not a good idea, because understand that looking at the news and reacting to the news gives you no edge whatsoever. And in the stock market, having edge is the only way to make money. Otherwise, the efficient market hypothesis exists. Now, when something hits the news, you have to understand that listening to that news, you are the last person to get to know that piece of information. If it is an important enough news, there are people way more powerful, way more smarter than you who already have access to that piece of information way before you and have already done what needs to be done. So whether it's a good news or the bad news, what you're seeing and reacting to right now is a very stale piece of information. So news should not be a part of your decision making whatsoever. If you do want to rely on something for making decisions, use past trends, especially for long term investing. 6 months horizon again is not long term investing by textbook definitions, because even if you do past price trend analysis, or if you're doing past quarterly and annual earning trend analysis, 6 months is not enough time to realize that kind of efforts that you are going to need to put in. So 6 months is still short term, and you should rely on something that has more predictive power, something similar to technical analysis or quant analysis, if you want to go forward with short term trading in the market. So DB Reality, what I can see is that it's currently clearly in correction. How do I know that? Look at the 75-minute time frame. 75-minute time frame topped out and gave a very beautiful positive divergence even before the price topped out. So when the price retested the 280 level, RSI on the 75-minute time frame had already started saying, boss, I'm done. The momentum is over. I am going down to the bear range. Tata bye bye. I'm migrating, right? So where the RSI earlier was oscillating between 80, 40 and 80. So here it gave a nice little positive divergence, move to the 40 level, 40, 80 level. Now it has gone into correction and it is oscillating between the minus and 60 levels. So I only want to draw the lower and the upper line. So I'm going to remove the upper line from here because I want to look at the support. When I'm interested in the support when the underlying trend is bullish, and I'm interested in looking at the resistance when it is bearish. So what are we seeing now? Are we seeing a potential end to the correction? Absolutely not. It does not look like the end to this correction yet. I would again expect a small bounce back, maybe 8 to 10% here. And I would recommend that you take that opportunity to make an exit on the stock because the underlying trend continues to look pretty bearish. And I don't expect the stock to start rallying again, especially given your horizon of 6 months. If you continue to hold the stock for the next 6 months, there's a good chance that you're going to experience further correction. And by further correction, a correction of this sort. So this was around a 55% correction, something that the stock has a tendency to do very often. So even if it does like a 50% correction, I would expect it to retest this previous real high. So this is the actual support for the stock. So my target on the stock would be around 130 for you. And it can take around next 3 to 6 months to correct all the way down to that level. So any bounce back of 8 to 10% that you see does have a strong resistance around this level of 170. I think you should use that to exit your position in the stock. Let's move on to the next stock, which is DLF, and the average cost price is 900. This is for Praveen. Again, bought right at the top, a double bottom formation, and very clear cut negative divergence on the daily chart indicating the end, or at least the intermittent end of the bull run. I can see that when the rally was still fresh, there also a negative divergence had been forged, but that was pretty short lived, not this correction. And DLF is actually a stock that responds to technical analysis really well, or rather gives very good technical signals, because here we can see it gave a really nice positive divergence before launching itself into a pretty sweet rally of how much? 182% in just 1 year. Very impressive, right? And after a clear cut signal that I am done rallying, I am going into the bear range, this stock has gone into correction. Now, let's take a look at the weekly time frame, and the weekly time frame does suggest that the stock has a very good underlying strong bull trend, but right now it's in a correctionary phase, and you are clearly on the wrong side of the trend because you always want to be on the right side. So technically a good time for you to hold the stock was between March 23 to March 24. Another good time was between again March 20 to up to November or October 21, right? Not after that. Right now, since the stock has started heading lower and the RSI continues to decline on the weekly time frame, it looks like the stock can decline or stay stuck in sideways correction until the lower support trend line is tested. So also taking a quick look at the volumes here, the volume is also suggesting decline with a lot of robustness. The supply side or the bears have the bargaining power, which means there is a pretty good chance that the price is. Now, remember what I said about I will tell you a little bit about my trading strategies or what I am doing. So, see, here I saw on the 15-minute time frame a positive divergence had been forged. And as a short term swing trader, I saw the stock come down and take a retest at the level of 40. So that gave me a signal that maybe in the short term, some upside can be experienced. So I bought the stock and the stock rallied around 5%. Now, ideally, I should have booked my profits there, but I wanted to wait a little bit longer. But I did not let my capital stay exposed. So I set a stop loss right below this blue line that you're seeing. This blue line is the 20 EMA. So my thesis was that if the 20 EMA gets breached, I want to get out of this stock. I don't want to risk it any further. So I set my stop loss there and I got stopped out. I did not re-enter the stock after that. Right? Good thing I did not. Good thing I had my stop loss. I was able to book a very small profit nonetheless. And I was able to mainly protect my capital from this 12% massive decline in the stock that followed. So this is something that I've done in a lot of stocks during this market correction. And by adjusting my time frame analysis, by adjusting my strategies to the market dynamics, even in the bear market, I'm able to make money, smaller money, lesser money. But I think just the fact that I'm not losing a lot of money, not burning my capital, not keeping my capital stuck is a win for me. And this is something that I'm also advocating to all my Trade Together program members, that using stop loss is the ultimate defense for you in a very dynamic, very treacherous, very dangerous playground called the stock market. So the next stock request is in Cochin Shipyard by Nitesh Gupta ji, and his average cost price is 0. So I'm assuming that you've purchased the stock with a slightly longer term horizon, and you need to know what would be a strong support and a probable reversal. Approximately what kind of time horizon would we need to anticipate to cover loss? That's a very difficult question. Not sure if I'm equipped to answer that, but I'll try my best. So first, let's draw some trend lines. Now, what is very evident from the rally? So see, Cochin Shipyard is one of those stocks which is very popular among retail traders, and for good reasons. The thing is that what gives me comfort is that the rally that the stock has shown has been backed by very good volumes up to the very peak. So if I show you, if I zoom in here, see, this is where the peak was forged, right? And up to the very peak, you can see that the price gain has been backed by strong growth in volumes. What does that tell me? That tells me that the correction that we are experiencing right now is merely a correction to this massive upside. Right? And in my opinion, the stock has started to give a fresh leg of rally from this point onwards, that is 22nd June 2022. And since that rally began, I think only the first and the third wave of upside has unfolded. So I do expect a fifth wave or a third leg of upside to unfold. So this was wave 2, and if you do a quick Fibonacci retracement on this, you can see the wave 2 retraced around 62% of wave 1, and then we saw a massive wave 3, which has so far only corrected 24%, right? Now, because the wave 1 was corrected 62%, which is a deep correction, the wave 4 is expected to be a shallow correction, and typically 24 to 38% is expected to be a shallow correction. So I think the level of 1080 is a probable strong support, which also coincides with this gray line, which is a 500 EMA of the daily time frame. So this is the support that you should look out for in Cochin Shipyard. Now, considering that the stock is very volatile and the rate of decline over here is, to be honest, slower than the rate of gain in the stock. So I think the stock can be in decline for maybe another month or so. But I am also confident that once the rally starts to come, then the recovery in the stock will be pretty rapid, and the next leg of upside should take the stock as high as 3000. So if you are comfortable holding on to the stock for the long term, I would definitely recommend you to do that. Continue to hold on to the stock for the next at least 6 months to 12 months, and you'd be fine. Now, I'm not promising an all-time high. Obviously, I don't have a crystal ball to gaze into and promise anything of that sort, but I do think that you'll be able to see recovery in the stock in the next 6 to 12 months horizon, not beyond that. So with that, we come to the end of today's market outlook episode. It has been a bad week. I know you might be emotionally disturbed. Personally, I have been asked this question a lot of times, that do losses bother you? And the answer is absolutely they do not. Because I believe in my strategy, I believe that I have an edge in the market, and I know that I am doing the things that I'm supposed to do. I have a system, I'm following the system. Profits and losses are just consequences. This is a game. You have to play by the rules. You have to do your part. If you're not doing your part, then you are going to get anxious. So if you're feeling any anxiety, it is because you don't have a proper system, you don't have a proper strategy, and you're probably gambling in the market. And if you want to have a one-on-one conversation with me, let me guide you. I'll be very happy to do that. You can just book a one-on-one consultation from my website. Again, the best way to connect with me, to get to know about my services and how I can help you in the world of swing trading, short term and long term, just join my Telegram channel, guys, and let's get started. So, with that, I'll take your leave. Thank you so much for joining in today. I will see you again in the mid of next week with my Let's Get Technical series, where the focus will be on answering your stock analysis queries and sharing as much knowledge about swing trading practices, technical analysis practices, and concepts with you through the assessment of your stock requests. So that's that. Thank